Understanding cost behavior, fixed versus variable, is essential for understanding and evaluating the profitability of a firm. This chapter explores the meaning of fixed, variable, and mixed costs. Managers who understand how costs behave are better able to predict future costs and make decisions. Fixed costs remain constant in total, regardless of the level of activity. An example would be the flat fee you can pay for Netflix Instant View every month. The fee is fixed because it does not change in total, regardless of the number of shows or movies that you watch. For fixed costs, the average cost per unit decreases as the level of activity increases. This is a key insight for improving profitability. As we increase our level of output, we can spread our fixed costs such as depreciation, insurance, property taxes, supervisor salaries over more units, thereby decreasing our average cost per unit. Variable costs, like direct materials and direct labor, remain constant when expressed on a per unit basis. If you rent movies from Redbox, the cost per movie remains a constant $1.25 per DVD, regardless of the number of movies you watch. For a manufacturing firm, direct materials and direct labor are the primary variable costs. Variable costs, such as direct material and direct labor, increase in total when the output increases. As you rent or watch more movies from Redbox, your total costs increases. Here are some examples of variable costs we're likely to find in different types of businesses. For merchandising companies, cost of goods sold is a variable cost. For manufacturing companies, direct labor, direct materials, and variable overhead are variable costs. For merchandising and manufacturing firms, costs such as sales commissions, shipping costs, and clerical costs such as invoicing are variable in nature. For service companies, costs such as supplies, travel, and clerical costs are all variable costs. To summarize our cost behavior, total variable cost is proportional to the activity level within the relevant range. That means as our activity level or output increases, our total variable cost increases. Fixed costs, on the other hand, remain constant regardless of the level of activity. On a per unit basis, on the other hand, variable costs remain constant over wide ranges of activity, while fixed costs increase or decrease depending upon the level of activity. Which of the following costs would be variable with respect to the number of cones sold at a local Baskin-Robbins shop? There might be more than one correct answer. Let's consider A, the cost of lighting the store. We need to light the store regardless of the number of cones that we sell. So clearly, the cost of lighting the store is a fixed cost. The wages of our store manager, B, are also fixed. They don't change with respect to the number of ice cream cones we sell, although we might want to provide an incentive policy to our employees whereby their wages, or perhaps they would receive a bonus if sales increase. But in general, our wages are fixed. The cost of ice cream is clearly a variable cost. As we sell more ice cream cones, we will use more ice cream. Also, D, the cost of napkins for customers is also a variable cost. As we sell more ice cream cones, customers will take and use more napkins. Let's consider some examples. Property taxes on our factory are fixed. They don't change with response to volume of output. Boxes used for packaging detergent produced by the company will be variable. As we increase the amount of detergent we produce, we'll use more boxes. Salesperson's commissions are typically variable. As they sell more, we pay them higher commissions. Our supervisor's salary in the factory is fixed. It doesn't change with respect to levels of output. Depreciation on our executive autos, typically if we use a straight line, depreciation method, our depreciation expense will be fixed. The wages of workers assembling computers in our factory will be variable. As we produce more computers, we'll need to pay our workers more money. Again, on a per hour basis, their wages are probably fixed, but in total, our wages of our assembly line workers are variable. Insurance on our finished goods warehouse, our insurance will be fixed. Lubricants for use on our machines will likely be variable. The more we run our machines, the more money we'll spend on lubrication. Advertising costs are fixed. Often this causes students to question, why would advertising be fixed? The idea is, if we spend more money on advertising, we will sell more. But think from a production perspective. If we make more of our product, do we necessarily need to spend more on advertising? Do our advertising costs change as our level of output changes? And the answer to that is clearly no. Microchips used in producing calculators. As we produce more calculators, we'll need to use more microchips. So microchips, our direct materials, will be a variable cost. The shipping costs on merchandise sold. As we sell more merchandise, we will have to incur more shipping cost. The shipping cost is a variable cost. Magazine subscriptions for our factory lunchroom will be fixed. The cost of magazine subscriptions doesn't change when our level of output or sales changes. Thread in a garment factory will be variable. As we make more garments, we'll use more thread. Our billing cost will also likely be variable. As we manufacture more product and sell more product, we'll need to invoice for a larger number of sales. Our executive life insurance will be fixed. It doesn't change with respect to output or sales. The ink used in textbook production, likewise, will be variable. As we produce more textbooks, we will use more ink.